Well, we're now on session 12. We've made it. This is the final session of the Business Planning Binge weekend. This is an amazing accomplishment on your part. I know I said it before, but your diligence is admirable. The effort you're willing to put into your own success and building your plan is fantastic. And we're so glad that you've allowed us to help you with some guidance along that way. Now, what we're going to talk about here in this is startup amount, funding sources, break-even analysis, and then we'll revisit the executive summary. So let's get into the startup amount. How do you figure out how much money you need? There's a way to do that, and I'm going to show it to you. And if you want a more expansive explanation, again, in the Stewardship Small Business Academy Module 1, there's a lengthier explanation of this, but you're certainly going to be able to, I'm going to illustrate it with an example, so you're going to absolutely see what I'm talking about and how to do it. Just if you want it reinforced, you can obviously either watch this lesson again or go into the more detailed one that's in Module 1. Now, why bother? Here's why: because no money means you're out of business. You've got to have money to be able to function with the business. You don't have to have a lot, but you have to have enough that you can keep things going. You've got to be able to buy materials. You've got to be able to pay your expenses. And when the money dries up, so does the business activity. It's that simple. So how do you make sure that you don't run out of money? Well, I know you're going to be surprised, but I got a spreadsheet for that. I created one so that you can plug in the numbers that you already have created or will be creating to plug in and see if you run out of money. It's the same spreadsheet that you were just using in session 11. So it's the SSBA_learn_templates and then _chart of accounts listing with account numbers. So if you've still got the one open from session 11, it's the same one, it's just another one of the tabs. Is the tab labeled REV, abbreviation for revenue, and EXP, abbreviation for expenses. So revenue and expenses, startup, and year one. So it's this tab right here. Here's the tabs you were using before. If you click on this tab, you're going to see this template for you to fill in some information. Here's a little bit of a zoom in on it so it's a little bit more clear for us while we're talking about this. Now, so let's figure out if this business has enough money to get through year one. So let's take a look at what data is on here. So this individual in this example has a total of $20,000 available to start up the business. So that's their initial funding of the company. So this is for a startup. You could do this for a projection as well going forward. If you're already in business, you'd say, here's the money I got right now. Here's what's going to be happening. Do I have enough or not? So either it will work either way. I'm just simply illustrating it with a startup. So they're going to start up. They put in $20,000 into the account, and then their expenses for startup. Let me just follow my own example here. So we're starting with $20,000. And then remember, we projected month by month our revenue, what we were going to be selling. So, that's where we took the sales projections. I think it was in chapter 9. And so for this company, I use these sales projections. And you can see, with their revenue, it starts off low, it builds up a little bit. But how do you know if you got enough money? Well, you've been tabulating what your expenses will be. You have your startup expenses, and then you have your month-by-month expenses, which is what we just talked about in the last sessions. So in this example, they've got their initial startup expense. So they put in the funding of 20, have an expense total for startup of $11,500, and they're going to have a cash balance of $8,500. So again, what's your funding, and then what's your sales, what's your expenses at startup, and then expenses month by month. You put those in this column, and then what that's going to give you is whether you had, essentially, it's not technically a profit or loss calculation, but for these purposes, you can think of it that way. It's, did you make money or lose money that month? So, you can see what's happening here is in this first month, see, in January, they didn't have any sales, but they still had expenses. So 0 sales, you subtract the expenses, parentheses in accounting world means negative. So they lost $6,500. Look at this one. In February, they had revenue of $1,000, expenses of $5,500. Therefore, they lost $4,500. In month 3, in March, okay, so they're making more revenue. Things are going the right way. Look at the revenue projections. They're building every single month. This is good. That's what we want to see happening. So revenue in March of $1,500, expense of $4,500. So expenses are going down, revenue's going up. That's what we want, right? And then, so they've got a loss of $3,000. Now here, look here, in April, here's where they turned the corner. $2,500 in revenue, $2,200 in expenses. They are $300 on the plus side. And based upon the revenue projections and expense projections for this scenario, for this company, then you can see the revenue is growing through here, then it goes down. But my point is they're on the positive side every month from month 4 on, okay? But were they able to stay in business? And unfortunately, they are not. They're out of business in the second month. So here was their startup, here was month 1, month 2, they had a $2,500 negative. Couldn't get through it. Then the next month it was 55 and 52 had they been able to stay in business. But if you're done here, it doesn't matter if you're making money here because you never get there. Okay? So let's just change one number, just one number to see if we can help the folks that start this business stay in business. So we're going to now start with 30,000. Our revenue, all the same, all these projections are the same, all our expenses, still the same, our surplus or shortfall, still the same, all that changed. But look, here's what's different. They've got money left. So in month 3, rather than losing money, they're on the pause. They've still got money left to operate. So they were able to stay afloat to when they became profitable. So here, it was a difference of $10,000 of what kept you in the game. And $4,500 is the lowest cash balance in year 1. Now, what I'm going to strongly suggest that you do is when you're figuring out how much money you need to start up, don't run this close to zero on your projections. I realize money doesn't just fall out of the sky, okay, but if you've got the capacity to keep your cash balance at least a few thousand, hopefully close to 5,000 or more, and I realize it depends on the volume of your business, all that type of stuff, but you want to have a balance in the thousands of dollars for your projected cash balance. Here's the reason. What if something really good happens and you come across an opportunity and it's going to cost you a few $1,000s? Well, if you did all your projections and only had your startup at enough to just not go to zero, and maybe you've only got a cash balance of $100 to $500 month per month, if a great opportunity comes along that's going to cost a few $1,000s, you can't take advantage of that opportunity. Or what if an expense is more than you anticipated? You don't want that expense to blindside you, knock you off your feet business-wise. You want to be able to get through that. So you've got to have a cushion in there. Now, so here it is. What this business needs is an additional $10,000 to launch, from $20,000 to $30,000. And then they're on the safe side. So there you go. There's your template. There's the spreadsheet that you get to use to do this. And then in the next segment, we're going to talk about, well, where can the money come from? That's fine. We figured out how much money do we need, but where can it come from? Okay, we'll talk about that next.